and international economics is broadly, as I understand, divided into two parts. The microeconomics part, which is sometimes called the pure theory of international trade, and the other part is the international macroeconomics, or open economy macroeconomics, or international finance, the various terms used in different places. So, I come into the part of open economy macroeconomics or international finance, and within that I will talk about capital flows, or rather things around capital flows. So some things around it and not just on capital flows. So I'll just say a bit before I move to the slides and then come back to the board. Capital flows, it's an awkward term actually, because as you would know, we divide things into stocks and flows typically in economics, and for that matter even in accounting. Now here, when we use the term capital flows, it is, the first word is capital, which is a stock, and the second term is flow, which is obviously a flow. So it's an awkward term, but that's a terminology which is more commonly used. The more appropriate term would be investment flows. Then there is no contradiction. Investment is a flow, flow is a flow, so these are both flows. And what we are really talking about is how much is the investment from outside into a country, or how much is the investment from a country into the rest of the world per period. So we are talking about flows here. And the other part is that when we are talking about investment, the term again is used in two senses in economics. One is real investment, and much of microeconomics or macroeconomics deals with real investment, which is capital formation. You set up a factory, that is real investment. Now, when we talk about international capital flows or international investment flows, we are talking typically about financial flows. So this is really financial investment flows that we will be talking about. So this is important because we are not talking about the import or export of capital goods. Sometimes there is confusion about capital flows and capital goods movement. So it's not capital goods movement that we are talking about. We are talking about financial investment flows. This has become increasingly more and more important. The history, in a sense, goes back to the early 1990s when liberalization took place, or rather one more step in the process of liberalization took place, an important step there. And that liberalization was both in the context of within economy and also in the context of globalization. There has been opening up. This has been opening up in trade of goods and services. It's also been opening up for capital flows, both inwards and outwards. Much of what I will have to say will be about the capital inflows, but increasingly even the outflows are becoming important. Not for the household sector as yet. But for the corporate sector, yes, there are substantial changes. A good example of that is, if I know my figures correctly, the Tata Group has half of its assets abroad and half India, something like that. So that just tells you the emerging picture. It's yet a story unfolding, but it's important to know that. globalization is happening at a fast pace. But one thing that you should keep in mind is that even now, even though the rate of growth of globalization is high, the levels are still not high, they're still not aggressive. And I have a slide to show. I think that will be the very first slide that I will show you. And just to give you a glimpse of that, even the much talked about FII movement, financial institutions, foreign institutional investors investing in India, they are in the news quite often, and when they suddenly invest, then the stock market goes up, and they suddenly move out, the stock market goes down. And there is a feeling that the FIRs play a significant role. That is true in one sense, and in the sense in which I just mentioned that they do move the prices a lot. But it's important to keep in mind that the FIR investment in the Indian stock market as a fraction of the total market capitalization is still not very large. It is large relative to the floating stock. Floating stock is the stock which gets traded. There is another stock which is with the promoters, whether it is the private sector or it is in the public sector. So a good example of that would be DLF, which has some 75% owned by the family. So it's only 25% which is floating. Even that I doubt is entirely floating stock. Similarly, if you take a public sector undertaking like Coal India Limited, again there is a small percentage which is floating stock. So when you take the FII investment as a proportion of the floating stock, it is on the high side. I wish I had the numbers here, but if you take the FII investment as a proportion of the total, then that is still not large. The point being what I was saying earlier, that globalization in terms of levels is still not large, though the rate of growth is impressive. The media discussion runs more around the growth, and even some popular books like Thomas Friedman, I think The World is Flat, popular book, bestseller. It's really more about the rate of growth of globalization rather than the levels of globalization. So there's a long way that we have to go, and this is not true of only countries like India, but even when you think of the US and Canada and the European countries, even there globalization is not too large. I'll just show you a bit of slide. So since I need a bit of board, so what I will do is I will go over the slides and then come back to using the board.
One small clarification. Remember that last that lecture you were attending that in that sticky auditorium about one of the interesting graphs which you also noticed possibly, that the US stock market and Indian stock market moving almost together.
I have a slide on that.
So, I mean, I'm just relating your argument here to that. I mean, maybe in this particular Coal India Limited or whatever the company, DLF and all, what phenomena you're saying might be true. But the thing is, if the pattern is very much in line with the international capital movements, are we not saying that the international market is really affecting the domestic market in a very significant way? And the domestic players also possibly responding to what the international players are doing effectively?
That is true, but it's a bit exaggerated. I'll show you a slide.
No, I'm just trying to relate the two phenomena at the macro level at financial markets level.
I will come to it. In fact, I have two slides on that. So this one first. There is often a lot of injections with theory. So here you have something which says that there's nothing more practical than a good theory. Even though best of us in terms of putting importance on practice, we are influenced by ideas. by theory. We may be conscious of it, we may not be conscious of it. But even the most practical businessmen, they carry some ideas in their mind. So it is theory at the back. So in that sense, there is really not a contradiction between theory and practice. So this is to give you an idea about the levels as globalization is concerned. This is from Pankaj came out. It's become a popular book. At MDI you would be more familiar with this. So here's some data. It's a negligible fraction of the mail which is international. Most of our mail is domestic. Telephone calls, university students. We'll also talk about studying elsewhere. The percentage of students studying in countries outside their place of residence, that is still small. And equity investment. So equity, and this is international data. So it's not about an emerging economy or a less developed economy. And what you see is that equity investment, it's only some 20% which is outside. So in fact, it's government debt of all things which has a relatively high figure. So even that is less than half, in fact less than even 40%.
But again, this is the international level data, which means all the countries of the world are together. The moment you say separate them into the low-income countries versus the high-income countries, these numbers may be twice or thrice of the numbers we are seeing here. If you take, for instance, OECD alone or EU together, these numbers may be phenomenally very different than what they are. The thing is, one of the problems with the averages is that the lower part is kind of given more stress and the higher part gets less stressed. So in a way, it possibly does not tell entire story in a way which possibly, and the second thing possibly which will be interesting to look at is these possibly numbers are maybe 2010 or something. Suppose the same numbers we look at in 1950s. Then the amount of growth which has taken place in the last 50, 60 years may be phenomenal, mind-boggling possibly than it has ever happened in human history.
So the last part that you said, that is the rate of growth, which is very high, which is phenomenal. Averages, yes, you have a point. This is averages, but from what I gather from his book, even for the developed countries, the theme stays, though not to the extent that this data would show. But yes, it would be interesting to look at the data for just developed countries, which are more globalized than emerging economies. But the point of this is only to convey the simple point that let us not exaggerate how far we have gone. Okay, so this is yen dollar exchange rate. So there are two graphs here. One is the ratio of the price levels, and the other is the exchange rate. So E is the exchange rate, that is the number of yens per dollar from 1980 to 2006. And as you can see, there are considerable fluctuations in the exchange rate. That is this graph, and it's not only short-term fluctuations. When you take the long period of time, then you see a lot of movement. For example, the price of dollar being something like 250 yens per dollar, and these days it's probably 85 yens per dollar in 2013, somewhere thereabout. And it has changed over time considerably in the late 80s, but even thereafter there are movements. One thing to note here is you can divide the graph into two parts. One is this part, which is the fluctuation, and there is another part which is the major one-shot change. And that happens often in the currency markets, where these jumps occur at one point of time, and then there are these what we may call the usual fluctuations. And in case if this same graph were to exclude this period, then one would get a sense of the nature of changes. Then one would say, well, yeah, there are fluctuations, but that happens in currency markets. But the point of the first part is to convey the larger changes that happen. To give you an example from India, in the early 90s, there was a jump, if I remember correctly, from something like 50 rupees per dollar to 20, and then I think from 20 to 25. So from 15 to 25 happened in a very short span of time. Then after that, there has been a slower movement, and then the somewhat usual fluctuation. The other part of the graph is the ratio of the price levels, and I'll take you to a bit of the purchasing power parity theory. I'll explain that, but for the moment that relates exchange rates to the price levels. Now, as you can see here, it is not following the price level ratio, but in a long-term context, the movements are somewhat around that. Now, this is of course only for yen versus dollar, and it's only for this period 1980 to 2006. So, a good data set would be where you consider a number of countries and a large number of years, and then look at how exchange rates are related to the price levels in one country vis-a-vis price levels in the other country. At the moment, I'm just stating the relationship, but I'll elaborate on that when I come to the board.
But the 80s is basically Plaza Accord issue also that forces Japan to reduce its kind of exchange rate.
Yeah, I think that's what happened then. Please feel free to ask your questions. This is most of the data is from the book Krugman and Oxford, International Economics. So this relates on the x-axis you have real per capita income, and on the y-axis price level. So what this shows is that the prices tend to be higher in richer countries. Just to give you a simple example, if a hamburger costs for, say, 55 rupees here, then one may have thought that, well, it would cost $1 in New York if you have the law of one price. The law of one price is that, well, the same good sells at the same price in two different places. Otherwise, there is an arbitrage opportunity. But typically, what happens is that a McDonald's burger of the same quality or similar quality, if it is selling at 55 rupees here, it would not sell at $1 in New York. It would sell at more, $2 or $2.50 or whatever. Similarly for the UK and other European countries. And as you go to, this is broad style aspect, as you can see there are deviations from that line, but the trend is clear. The richer the country, the higher the price of the good. this is growth rate of international reserves, and she sets industrial countries, developing countries, and then all countries. And on the y-axis, it's not the amount of reserves, it's the growth rate of reserves. And for industrial countries, there is not much of a change. If at all, there is a small decline also. But it's for the developing countries, and particularly after this period. So from in the 1990s, you have the growth rate, which is increasing. So the growth rate positive itself means that the reserves will be rising. So what this is saying is that not only are reserves rising from year to year, but they are also increasing at an increasing rate. The growth rate is going up for developing countries, and some of it has to do with the currency crisis or financial crisis more generally in Mexico and Argentina and in East Asian economies 1997-98, when there was a need felt for these larger foreign exchange reserves. This is again on reserves, international reserves held by developing countries, and this is, I think, a percentage of output.
Yeah, percentage of GDP. I think the top is.
Yeah. So this is percentage of GDP, gross domestic product. And there it was the growth rate. Here, even as a percentage of GDP, you can see that these are going up. For all developing countries, you have a curve which is average over these countries, and of course, China having not only large reserves compared to other countries, but the percentage going up over time. India, it was increasing till about 2004 as a percentage of GDP. Thereafter, it's been somewhat stagnant, and in fact, of late, this is data only up to 2007, but of late, the foreign exchange reserves as a fraction of GDP has fallen somewhat. Because the absolute amount hasn't changed much. In fact, the absolute amount also fell. This is the Chinese currency. It was pegged to the dollar. It had a fixed exchange rate. After that, it has become somewhat floating. But there are issues about that. We spend a little time on this later. This is this is the current account surplus or deficit. Current account refers to the gap between exports and imports. And if you look at that, then many of these countries had deficits till 97. So they were importing more than they were exporting. 97, 98 is when the East Asian crisis occurred. After that, you see, for these countries, you have surpluses. There is a change there, which has not happened in India. In India, we have a story of current account deficits for a long period of time.
I mean, there was I think Stiglitz is here. You must be reading newspaper items and all. He says whatever the current account deficit in India is actually more than done well with the Mauritius route coming in, which is basically, he has stated publicly that's basically for Indian money coming back. So effectively, India is actually capital exporter rather than, I mean, officially, yes, we are having a deficit and require foreign investment and all that. But that's another question mark which is put in our context of.
That is possible. The data on that, of course, is problematic. But from information about tax evasion and
No, but one thing is very clear that in India, the biggest contributor of investment is Mauritius. And Mauritius, everybody knows, it's the Indian money which is coming back, basically. I mean, Mauritius is not really there foreign investment coming from America or some other countries. Mauritius cannot have enough money to bring so much money to India.
That is true, but even some of the foreigners would be interested in reducing the tax burden. So even they could be using the Mauritius route. Now, how much of it is tax planning by foreigners and how much of it is tax evasion by Indians, that split one doesn't know. That becomes a little hard.
That's true. But I think it's more likely to be more Indian because Indians know the Indian law best. So it's more likely that the people who are bringing the money are Indians. The foreigners will take time to figure out these like Vodafones and all, which probably do the same thing. And they will not possibly do through Mauritius, they will do through Cayman Islands and others which they do already. They would not want to go to Mauritius route because that's dominated by Indians in a very significant way. That's capital account. I mean,
but just to...
but the thing is, if you have a deficit there, you need to have it from the capital account, some money coming in to finance the deficit.
Before I take the question, just to relate the only terminology. This is current account deficits. When you have the balance of payments account, and I'll come to that. So if you have a deficit on the current account and you have a surplus on the capital account. So the Indian story is that you have a current account deficit and you have a surplus on the capital account, which means that there is capital inflow. So what you were talking about just now was the capital inflow part, which is the counterpart of current account deficit. Yes. It seems two or three things. One is considerable depreciation of the currency, which
negative 5.6 plus 10.3 average level of depreciation. That was 15 to 20%.
Depreciation of which Thailand?
No, of the Malaysian currency.
Malaysia was not so much, but the other countries were definitely.
So that's what the total is because their exports stay the same relative to palm oil. So how is it that the deficit has become into a current account surplus in such a short span?
No, as I said, it is not any arbitrary year. 97, 98 is a crisis, East Asian crisis, which changed a whole lot of things. And one part of the change was considerable depreciation. So that is one part. The other, there is also some change in policies that have occurred and a conscious attempt on the part of authorities to avoid deficit. See, the story ran like this. These East Asian economies had deficits on the current account and they had surplus on capital account, so there was inflow. In 97, there was a sudden stop to the inflows and not just sudden stop, there was also outflow from these countries. Now, that is when it imposed a large cost. There was a major change in policies, some consciously taken and some forced on these. And thereafter, then you have a surplus on the current account there.
Also, the thing is, before the pre-crisis period, most of the countries did not have enough foreign exchange reserves. So that was one of the reasons the crisis, they believe, had been caused. Now after 97, everybody became very, very jittery about not having reserves. So everybody wants to build up reserves. So to build up reserves, you're doing all kind of possible things to promote export, to curtail imports. Depreciation automatically works. The non-automatic things also which these countries initiated, which completely changed the story from a deficit to a surplus story. And then if you look at today, now the surplus generation, that foreign exchange reserves has been also in these countries.
And this doesn't show the data for some developed countries, particularly the United States. But in this period, US has been running large current account deficits. So to some extent, the counterpart of these surpluses is the deficits there. This is what we were talking about earlier. So this is correlation of capital efficient returns for all markets. So what this is saying is that if you look at the, just to simplify the story, if you consider two countries, let us say India and the US, and you look at the stock price movements, then when the stock market in the US goes up, the stock market in India, does it go up or stays the same, or does it go down? Now, if the US market goes up and the Indian market goes down, that would be a negative correlation. If the US market changes and India doesn't change, that would be zero correlation. And in case both go up together or both go down together, then that would be positive correlation. So what this shows is that there is positive correlation. Just to say a little about the diagram, what you are doing is you're taking you could calculate one correlation figure with all the data that you have. So that would give you one number. But if you take a subset and keep deleting one observation at the back and including one new observation, and you have a number of data sets in a sense, then you calculate the correlation for each of those, and then you have different numbers. So the correlation is changing, which is why you have these fluctuations in the correlation between financial markets. And this is impressive data, very long term, 1860 to 2000. And one part of the story is that the correlation is positive, which is the concern that he was expressing, that you don't really diversify by investing in one country and in another country. They move together. The other part of the story, which is also important, is that the correlation, if you look at some kind of an average correlation across these figures, would be possibly 0.25. So, though there is positive correlation, it is not a number close to 1. So, the correlation is not high across countries. It is positive, but it is on the low side. So, which means that there is some scope for diversification, for globalization in so far as these investments are concerned. That is one part. The other part is that if you look at the jumps in the markets, then those don't get well captured in this kind of calculation. To give you an example, in 1989, 1990, the Japanese stock market crashed in a short span of time by some 50% or something. And of course, it continued to fall thereafter. It reached a peak of 39,000 Nikkei index in 1989-90. Today, it is at about 10,000. So you have a long-term decline, but you also have a crash at that point of time. Now, what this kind of a calculation does is to treat that as one of the observations. Now, but that one of the observations is a very serious, important observation. So it doesn't tell the entire picture. Let me explain this further. Suppose you had a Japanese who, there are considered two Japanese, one who had invested only in the Japanese market and another who had invested partly in the Japanese market and partly, let us say, in the Indian market. Now, even though there are these usual correlations across markets, the Japanese who had invested partly in the Indian market, in around 1990, the BSE Sensex was at about 1,000. That is about 19,000 today. Of course, we have to take into account exchange rates and so on. But the point is that a Japanese who had invested partly in the Indian market would have really come far ahead of another Japanese who had invested completely in the Japanese market. So if you ignore that one observation of a crash or a steep rise, then it doesn't tell you the entire story. Let me give you one more example. In 2000, Nasdaq crashed, so did the Dow Jones, but the fall in Nasdaq was a lot more dramatic. If I remember the figures correctly, it was a fall from something like 5,000 to less than 2,000 in a short span of time. Now imagine an American who had invested only in the Nasdaq, or for that matter, a little more generally even in the Dow Jones, and another American who had invested partly in Nasdaq and partly in the BSE in India. Now this would say that, well, there's a positive correlation. But from 2000 to 2013, the Nasdaq is down from 5,000, it is, I think, 3,000 or thereabout currently. So you have a 40% fall there over a 13-year period, whereas the BSE Sensex around 2000 was possibly 3,000, 4,000, and it is at 19,000. So when you consider inclusion of these major changes that happen, which are not getting captured here, then the benefit from international diversification is large. Here is an example to understand that phenomenon. What I just narrated was the inclusion or exclusion of an important year in which a crash occurs or a fast rise occurs. But this is considering the more usual fluctuations. And why is it that we have the impression that diversification doesn't pay across international markets? Consider this very simple example. Few observations. Two countries, there are two columns there, and few observations in these two rows here. And consider the case where there is a 1% rise in both the markets. So that is, it happens in both the countries, and it is quite possible that it becomes newsworthy because, you notice that, well, the market rose in the US and the market rose in India. So in Mumbai, in Delhi, there would be reports that how come the market rose? Well, it rose in the US as well. So it gets media attention. Consider the second case. The US market falls, the Indian market falls, and again, let us say by 1%. So again, it catches attention that, well, something happened there, something happened here. Consider the third observation now, which is that country one, the market goes up, and the other one, the market goes down. Now, this may not, of course, the fact that it has risen, that would get attention. But the other aspect that it has risen in one and not risen in the other, in fact fallen in the other, that doesn't make it a very newsworthy item in the context of thinking about globalization and markets going up together or falling down together. So the way the mind works and the way the media draws attention is that we notice the first two but not the third. And look at what happens to the correlation calculations. If you intuitively think of correlation, you would think of it as very high, and indeed in this case the precise calculation is correlation of 1 if you consider only the first two observations. If you consider the correlation with all three observations, it immediately drops from very high to low. It is positive because the first two observations have a role to play. So, of course, if you consider only the third observation, then it would be negative correlation. But if you, which is not a good thing to do because you are ignoring majority of the data. But if you take the entire data set, then you have a low correlation. Now, what the previous slide showed was data with this, but the public perception is more around this.
So if you net out the newsworthy events in the same graph, can be reformulated and that can give a possibly completely different picture. It's like outliers. The crisis points are like outliers. So if you remove the outliers, the correlation may improve significantly.
No, there are two things. So the earlier story that I was narrating was about the crisis or the extreme outliers. This is not about inclusion or exclusion of outliers. This is simply about what is newsworthy and what is not newsworthy. I take interest in behavioral finance. Some of you may be having some exposure to that. So psychology plays an important role in financial markets, and a lot of public perception is using some economics, and there is an element of psychology too. So one needs to be very careful. One needs to be on one's toes. And of course, the overall change is that there is +2 in one and -1 in the other. So it does pay to diversify. Let me deal with it now that I'm doing the slides in one go. So okay. This is about being able to handle the problem of investment. Now, forget about international investment. Even domestic investments or domestic financial contracts, implicit or explicit, you have a basic problem, which is that when you lend money, you could talk about debt or you could talk about equity. Let me, for simplicity, consider debt contract implicit or explicit. So, if you lend me the money, you have to have a way to get it back. Now, of course, one way is that I am a very honest man. So, you give me the money and I will pay you back, for sure. The other is that there is a social mechanism. Social mechanism in the sense that you lend me the money, if I don't pay you back, you go to tell all your friends and all the faculty in India in one way or another, and they get to know that I am misbehaving. So that is the punishment for me, and to avoid the punishment, I will pay you back. So there is a way of enforcing. Now this is not a legal contract, but there is a social way of enforcing the contract. The third is that you have a formal legal contract, and if I don't pay you, then you can go to the court, and anticipating that you can go to the court, I would behave, and behave here means that I would repay the money. Unless, of course, I am not in a position to, in which case it's a case of bankruptcy. That's a different story. Now, you have this problem in any kind of financial contract. There is an added dimension when it comes to international contracts. So if you have an investor in the US lending money to some company or some individual in India, then there is a new dimension, which is that you have to not only ensure that there is commitment on the part of the borrower in India, but you also have to ensure that there is commitment on the part of the government of India. The government plays a role here. Why? Well, what can the government do? Well, take the case of nationalization or confiscation. So you have a US investor setting up a plant here, and then due to various reasons, let us say the legislature decides that this foreign firm should be taken over. Something of this sort has happened in some countries like Iran, for instance, and many other places. So that is outright takeover. Another form that it can take is that you have a contract in terms of rupees. So somebody in US gives me $1, it is contracted as 55 rupees. I'm supposed to pay back 55 rupees. Now after 3 years, the contract says 55 rupees, so I pay 55 rupees. Now the government of India wants to help the Indian citizen. So it maybe because we have a recession here, maybe because we've had a drought here, or maybe for nationalistic reasons, or whatever be the concern. So what you can do is to have a lot of money supply being pumped into the economy. The Indian price level goes up, and related to that, the Indian rupee goes down. Now, 55 rupees is $1 at the moment. 3 years later, I am returning $55, but 55 rupees. But 55 rupees at that point of time may be only half a dollar. Now, in so far as fulfilling that legal obligation is concerned, I have fulfilled that commitment, but effectively I have defaulted. And it is not that I have defaulted, it is the government of India and I, the two together in a sense, that have defaulted. Now, the foreign investor can anticipate this ex ante, the possibility of this thing, and then you have a reluctance to lend. Now, when there is a reluctance to lend at that stage, then the possible benefit that the government of India wanted to give an Indian citizen is ruled out, because there is no lending in the first place. So, in that context then, the government is not really helping, except for some occasion in the past where it may do so and help. But if you consider the long-term implications of that, then they can be negative rather than be positive. Now, let me come to this area. In the context of domestic financial relations, you have a single agency problem. Are you familiar with principal agent?
Yeah.
So, good. So you have the lender, you have the principal, and you have a borrower who is the agent, and you have a principal agent relationship in these financial contracts. And in this, of course, in a broader sense, the government is always in the picture and it's there in the background, even in a domestic financial relationship. But here in the international context, it becomes, in a sense, more active or relatively more important. So, in a domestic context, for simplicity, you can say that there is one principal and one agent. In the international context, and this is what you do your own, you in a sense have two sets of agents. One is the borrower who may misbehave, who may by design go into bankruptcy. For example, I have a commitment to repay the loan. I can repay the loan only if I have assets. I have assets. Now, just to give you an example, suppose I sell some of the assets or some of the goods against black money instead of white money. That doesn't get accounted. So, even though the firm is actually not bankrupt, I have colored that other money privately. The firm on its books shows bankruptcy and is not in a position to pay. So there is an agency problem that the lender has to take care of. That is the first part. There are the borrowers. So in the usual principal agent problem, where the principal is the lender and the borrower is the agent, this is not really important or active. But in the international context, now you have not only the private borrowers but the government. So in a sense, the government of the country in which you have a borrower plays a role, and it's a role somewhat similar to what an agent can do. An agent can misbehave from the viewpoint of the lender. These are all relative terms. And indeed, some of the governments may have their own very good reasons. You may have a reason like saying that, well, for 300 years the Westerners ruled here and they have taken so much, so it is justified. Whatever else, that could be one way of looking at it. The other way could be that you are anyway rich, so this is legitimate, whatever. These are more difficult questions. But without going into them, all that we are saying is that the government can come into the picture effectively defaulting wholly or partially on the funds raised, whether it takes the form of debt or it takes the form of equity. So there is this dual agency perspective, and that makes international financial transactions harder than domestic financial transactions. Now, earlier we talked about limited globalization. So, one possible reason is that you do not have an international government. So, if you did have an international government, then that international government would step in and tell the government of the borrowing country not to misbehave and fulfill the commitment. And given the presence of a referee at the international level in the form of an international government, then you may have more globalization. And in fact, the borrowing countries which lack capital would possibly be getting a lot more of capital with which they could develop more. Now, what I've just said is a very simplified story. In fact, I spent some time on how the inflows or outflows are not unambiguously good for emerging economies. But leaving that part aside for the moment, the fluctuations part aside, if you take the if you take the more basic story, which is that the developed economies have a lot of capital and the developing countries or the emerging economies have little capital, and that returns on capital there are low, the returns on capital here are high, then there can be a mutually beneficial exchange where you have financial investment flows from developed countries to emerging economies. But this could be a problem on the way, which could also explain why the flows are not as large as one would expect them to be.